harvest. So you would not think that that business would grow all that much. It will grow based on amount of opportunity in the world, not because we will it to be bigger. Hybrid has many of the same characteristics as the private equity business, but it is early in its life. And then you turn to credit or yield, and that's 350 billion. And that sounds like it's a big business, but in the context of the markets in which it participates, it's not yet relevant. We may be the largest private credit business in the alternatives. And again, alternative to publicly traded stocks and bonds. But we have a long, long way to go. And the need for yield, particularly safe yield for institutions and for individuals, is just massive. So I would expect that business to be twice its size over the next 5 years. I would expect the equity businesses to be larger, but it's not like I'm willing one to be bigger or not. The market and the reality of our business is telling us which of these will grow and which of these will not grow.
And we'll come back to that in a second. Now, Leon Black remains Apollo's biggest shareholder. Do you ever turn to him for advice?
No, at this point, both Leon and Josh are completely out of the business. Josh remains on the board, but this is a business I know well. And I joke with people internally, it's not a hard job, it's just a lot of work.
Got it. So let's talk a little bit about, or a little bit in detail about your credit platform. A lot of people look at Apollo and it being kind of like, a big lender, big capital provider now to people like, Softbank or General Electric. And they say, here's another bank. Is that fair, unfair, accurate, inaccurate? Where do similarities end and where do differences start?
So I'll start in a slightly different place, but I'll get to where you want to get to. So in the US, I say Dodd-Frank worked. When the financial crisis hit in 2008, regulators in the US and Europe looked at the banking system as overlevered, as overextended, as undercapitalized, and introduced a series of reforms which have resulted in banking 2022. A lot of the banks shrunk in size and a lot of personnel left the banking business. And if you look at the US today, about 25% of capital, debt capital, comes from the banking system, 75% from the investment marketplace. In Europe, it's about 65% from the banks, 35% investment marketplace, and in Asia, it's still 85% plus coming from the banking system. So how did we get from where we were in 2008 to where we are in 2022? Well, a lot of the credit creation is now outside of the banking system. And so if you think about what a bank does, a bank is lending long, investing in businesses, providing credit, making loans, and borrowing short through deposits, which are on demand every single day. As a result of that imbalance, banks are attached to provide liquidity. For us, we are not mismatched in terms of assets and liabilities. We have a lot of assets, a lot of liabilities, or a lot of need from investors who are long-term pension funds, from our own insurance platforms, or for others. And what they need is safe yield. But public markets no longer offer any alpha. This is at least our belief. Public fixed income markets no longer are a source of alpha. So the way we have elected to get excess return per unit of risk is to step back from public markets and look for safe yield. And the place we found that is in origination. So many of those things are things that you would have heretofore associated with the banking system. We make loans, we make revolving credit loans, we make asset-based loans, we lend against equipment and aircraft and mortgages and other things. We provide trade finance and receivables finance and sale leaseback and so on and so on. And what we're trying to do is, as a result of taking less liquidity and more flexibility on structure, get excess return, but without taking credit risk.
Now, when banks lend, they often have, retail deposits behind them. You have funds and, credit fund investors.
services industry, if you look at the US and Europe over the past 15 years, it has raised, I'll be generous, no capital. In reality, more dividend has been paid out as capital. If you look at what we've done, we've gone from initially a very small amount of capital to now almost 25 billion of capital. We've raised more than the entirety of the industry. And the strategy that we're following of taking a little bit of liquidity risk, a little bit of structure risk, rather than any other type of risk, is now being employed, across the industry, including by what you would consider more traditional companies and otherwise, because this is the direction of travel. And this is what I think people fail to understand. The last numbers I saw for US is there used to be 6,000 public companies. There are now 4,000 public companies. It does not surprise me, therefore, that increasingly people are investing in private assets. There's just more of them. Private does not mean different credit. It doesn't even mean lesser credit. It just means private. And we're seeing the same thing that's happening in the retirement services and insurance industry take place across institutions more broadly, pension funds, endowments. And now we're seeing it in high net worth and in retail. The level of comfort that people have investing in private companies is just so much greater. Whether it's a European soccer league or the NBA or the NFL or well-known companies like Mars and others, all of these are private entities. It doesn't make them any less creditworthy. It just means they're private.
Got it. So maybe, and I appreciate it's a little bit complex, maybe we can explain it by looking at a specific example, maybe a transaction has been already announced. For example, the Softbank deal, where Apollo provided $4 billion in capital to Softbank's Vision Fund, and that was secured against the Vision Fund's assets, a lot of startups, Vision Fund's equity, in those assets, which from the outside, one would think, venture capital, startups is kind of like pretty volatile. You explained, how already, you don't take that kind of liquidity risk. And I appreciate that we're not talking about property and casualty insurance or anything like that. But, Athene was part of the deal. And, Athene is liable to pay out on its annuities to people, right? So explain to people from the outside what is fundamentally seems to be like a venture capital deal in many regards. Why is that not risky for a reinsurer?
Well, let's start with of the 250 billion of retirement services liabilities and assets. Any one deal is a de minimis percentage. So the first thing you do is you run a proper diversification. The second is it's a question of where you are and where you attach in the risk. So let's actually talk about the risk. 4 billion was lent to Softbank Vision Fund 2, which is $45 billion of cost. It's not a speculation on the ventures. It's a speculation that 4 billion of value against 45 billion of cost. That security, in fact, went to the rating agencies and was rated single A because of its very low leverage and covenants and attachment points and the backup of Softbank. While Softbank has the equity risk, we have the senior secured low leverage risk. And so when I think about risk and reward, for taking that single A risk and providing that amount of leverage with covenants, with everything else, you earn excess return versus a typical single A. And then you step back and say, well, that's a relatively small percentage of assets in addition to being a good risk reward. So of the 4 billion, about a billion plus minus went to Athene. The rest was syndicated to other investors, other insurance companies, other institutions, other mutual funds, who also saw the value of mispriced risk at a relatively secure attachment point. And it's the emphasis is always, again, when you think about the business that we've tried to build and the thing that distinguishes our credit business, our yield business from what others have done, we like to say it's fixed income replacement. So institutions, be they insurers, mutual funds, or others, they need yield. To get yield, if you buy my first premise that there is no alpha left in publicly traded markets as a result of a sea of money and open-ended mutual funds and ETFs and derivatives traders, where do people go to get excess return? Well, they have a choice. They can take credit risk, go into high yield, go into subordinated. You can take duration risk or interest rate risk, or which, by the way, we think are not appropriate risks to take, or you can take for proper investors a little bit of liquidity risk. That doesn't mean illiquid. It just means it's not daily liquid. And you can have a little bit of complexity or structure. So one steps back and thinks about, in a world we live in with intense technological change, with volatility in markets, with interest rate volatility, with tight credit spreads, where do you go to get return that is relatively safe? And we think we found it. And it's not just about the Softbanks of the world. It's about providing a series of services that you can earn excess spread on and get paid for. Again, receivables finance, inventory finance, secured finance, transportation finance, structured finance. We've done large transactions with ADNOC, the Abu Dhabi National Oil Company. We've done about 19 billion of lending against energy transition projects with investment grade sponsors. We've done it with Anheuser-Busch. We've done it with Hertz. We did it a week and a half ago with Aldar, the Abu Dhabi real estate champion. So SoftBank is just well known, but when you dig into the details of what we do, we're thinking 4 billion against 45 billion for excess spread.
That's great. And there's many exciting things happening in your credit business. I want to move on, just kind of like to cover some other exciting things that Apollo has in the works, and some very ambitious targets as far as retail investors are concerned, like a big target, right? I think you're looking for a 50 billion targeted pool there by 2026. Can you talk briefly on how you're looking to get there through, I know you have, BDCs, ETFs, other products. Just talk a little bit about the retail channel.
Sure. We're in the midst of what I'll call it just an incredible democratization of finance. The size and the pool of money in the hands of individuals, be it as a result of the market boom over the last 10 years or generational transfer of wealth, is awesome. And very little of it is allocated to alternatives, keeping in mind that alternatives does not mean private equity alternatives, just means an alternative to publicly traded stocks and bonds. And so what you have is a first round of legal liberalization, technological advancement, and increased sophistication on the part of these investors, which have resulted in a massive market that's been created for serving them. That market is currently around BDCs, non-traded BDCs, non-traded REITs, and traditional fund offerings. But if you think about what's being offered to them, very little of what I've just said is new. All of these are simply products that existed, except for the first time they're being offered to individuals, to retail, with institutional style fee structures, meaning no double fees, no excess fees, with high quality managers. We as an industry, not just Apollo, we've spent 35 years creating institutional products for sovereign wealth funds, pension funds, endowments, but who have very different needs and very different tax situations than high net worth investors. I think the next stage of what you're going to see are products and services created specifically for this wealth channel. To serve this wealth channel, you have to reach them where they are. A lot of them are with the big wirehouses, think Morgan Stanley, UBS, and JP Morgan. A lot of them are with RIAs or independent advisors, people who've set up their own shop, and a number are with other forms of broker-dealer, and some, in fact, you reach directly. And you have technology that now connects all four of those distribution channels. That's where we are. So we've made big investments in personnel. We've gone from fewer than 10 people to more than 130 people in our retail channel. We've made significant investments in CASE and ICAP, and we'll likely make more in technology providers to link this together. And we've launched a number of products this year, BDC being the most notable, that are gaining traction in the market and showing us just how robust this demand is. I think we're in the very early innings, and I would expect that by mid-year, we will launch the first of this next wave of innovative products. And by the beginning of 23, we will be fully launched with what I'll call wave 2 of products designed specifically for this marketplace. Athene also gives us a lot of experience in doing it. Keep in mind that this year we'll do 5 to 10 billion of retail in Apollo traditional. Athene last year did 37 billion of organic originations. This year, I expect Athene to do 40 billion of organic originations. A lot of the distribution channels are the same. A lot of the learnings are the same. A lot of the technology is the same. But I see this as a very, kind of interesting channel, and one that I expect to mature greatly. And the people who run it at 50 billion, I think have an easy job.
And I know some of the growth of these channels are also, subject to regulatory restraints. Do you see private equity being part of 401ks, or us being able, to trade alternative assets using our, trading apps on our phones? Do you see that being available anytime soon?
Well, it just depends on your definition of soon. I think there's this inevitable trend of democratization. Depending on the politics of the moment, it advances more quickly or more slowly. Right now, it's advancing more slowly, but it is really about democratization. Heretofore, the services of Apollo and our peers have only been available to institutions and to the highest of high net worth individuals and family offices. And so the ability to offer on institutional terms the same product and services is seen as a benefit or a democratization to a broader group of customers. Whether it starts in private equity, and that's what 401ks are allowed to invest in, I don't know. But keep in mind, and I come back to this constantly, an alternative is not just private equity. An alternative is just an alternative to publicly traded stocks and bonds. 401ks are meant to be very long-term and very illiquid. You're holding them for retirement. They are another interesting place, and actually the perfect place to take liquidity risk if you want yield rather than credit risk or some other sort of risk. But this is a journey, and this journey of democratization is in its very, very early stages. But I expect democratization, liberalization, and technological improvement to continue to be 3 really powerful trends helping the alternatives industry, not just Apollo.
Got it. And one more question before we move to audience questions on sustainable investing. So last week, you officially unveiled your sustainable investing platform, also with ambitious targets there. I believe, $50 billion over the next 5 years. When can we see, you think, dedicated sustainable investing products out of Apollo? I know you do impact investing at the moment, which is ESG related, but when do you think we'll see, a climate change focused fund, for example?
I think you'll see it this year. And, look, we have added a tremendous amount of sustainability, intellectual property, and intellect to our platform. People are attracted to come here because of the outsized impact that we are having. We are a financier, and generally we are an innovative financier, which means we are tackling a lot of these energy transition and sustainability projects. We did an inventory, as I suggested, of what we financed over the past 3 years, and it was, depending on definition, $15 to $20 billion. Now, when you step back, a lot of that was yield, some of that was hybrid, and some of that was equity. These opportunities don't come in one shape or size. But when I think about how we've become successful and how some of our peer firms have become successful, I think about the word ecosystem. We have a massive private credit ecosystem. We're 350 billion. We have a big balance sheet. We have lots of people. We have lots of intermediaries. We see everything. I can't think of the entity in the financial world that has an ecosystem in energy transition or sustainability. I don't think it exists. I think it's really early days. Our goal is to be one, there will be more than one of those players that has a massive sustainability energy transition ecosystem. A lot of what we do will provide financing, which is yield. Some of it will be hybrid, some of it will be equity. But if we can scale this quickly, we will see every transaction, every management team, every project. And the data that we get, the information we get just makes us a better and better lender and helps us scale our ecosystem. So in terms of priorities for Apollo, it's right there at the top. This is the direction of travel for the world. It doesn't mean the only thing that is happening. The brown to green is a very powerful trend, but we're all moving towards sustainability, toward notions of energy transition. Many countries have their own definition of what that means. We'll find the definition that works best for us, but this is a very powerful trend, and I think you'll see us make meaningful progress with dedicated resources and funds this year, led by my very talented partner, Olivia Wassenaar.
Will you finance fossil fuel companies if that means them transitioning out of fossil fuels?
Of course.
All right, so let's turn to some audience questions. I have a few of them focused on your DEI policies and Apollo as a workplace. One question is about portfolio companies. What has Apollo's approach been with regards to minimum wage benefits for employees of its portfolio companies?
So it's a broader, but the answer is right now the world is in deficit for workers. And so I'd be shocked if there were any issues around minimum wage. Minimum wage, in many ways, we're looking in the rearview mirror. Now it's about attracting workers and really building the workplaces of the future. And what we do at Apollo, we set the example for the portfolio. But yes, our ability to have a portfolio and ownership of equity allows us to have outsized impact. So the programs we have at Apollo in sustainability, we transfer to the portfolio companies. The approach that we have to opportunity in the workplace, we transfer to the portfolio companies. So it is not just the 3,500 people at Apollo and Athene where we're implementing these policies. It's at the hundreds of thousands of people who work throughout the Apollo portfolio system where we are having the same sort of impact.
Got it. Another audience question. Is there potential for Apollo to do what it did with Athene, basically, an insurance or reinsurance platform we helped launch, manages assets, and then basically acquire it, take it in-house? Is there potential to repeat this with other partners such as Athora or Challenger or someone else?
I think it's early days. I think we have to step back and remember, the world is not short insurance liabilities. The world is not short capital. There's plenty of capital. There's plenty. What the world is short is assets. Assets that are appropriate from a risk reward point of view is what is in deficit in the world. Therefore, we wake up every day and our job is to generate more assets for our clients. Our growth is limited by our ability to generate appropriate assets, not by our ability to raise money. And so if you look at our business today, our yield business is about 350 billion, 250 billion is for affiliates, and another 100 billion is for primarily third-party insurers. I expect the third-party business to grow massively, because what people like about what we do, and this is sometimes hard to understand, we have spent more than a decade really the detail of what it means to put an asset onto an insurance company balance sheet, what's appropriate for Solvency II in Europe or for NAIC in the US. We run a diversified book, and when we own a piece of something like Softbank, that people take comfort that we are not coming to them as a broker. We're saying, we like this so much, we put $1 billion on our balance sheet. How much would you like at the same price and under the same terms? And so increasingly the word alignment is how we think about the business. We hope to be aligned with our clients, and that probably is a good model for Challenger and Athora and others, but I think it's early days and too soon to say.
Now, it must be nice to have kind of like this big capital base, and you still fundraise, you still have, many funds, and you're launching new ones, but that Berkshire Hathaway aspect of it must be attractive, this captive capital base, and not having to go around people, with the hat saying, can I please have some more? This must be tempting a little bit. Do you see the mix at the moment is 50%, captive assets, 50% funds? Do you see that remaining roughly in line, or could over time just, the fund business more broadly minimize a little bit?
No, look, I want us to step back and realize that a retirement services business is 95% fixed income and 5% alternatives. That is the business. And so when you think about it, what we offer clients, whether they're clients of our yield business, clients of our hybrid business, or clients of our equity business, what we offer them is alignment. We are not in the Berkshire Hathaway model. We're not internalizing and buying companies with our own capital base. We run a fully diversified book, and we run a business based on alignment. So if you think about the asset management business more broadly, for the most part, asset managers receive a fee for selecting assets for clients. Those assets do well, that's great. Those assets do poorly, not so good for the clients. Fee is still paid. What we are telling clients, and the way we come to market, is as an aligned asset manager. We own the same thing that you own, which does not guarantee the outcome, but it guarantees a shared outcome. But we wake up every day, we think about asset management. We go to sleep every day, we think about asset management. What is in short supply in the world are appropriate assets, not insurance liabilities or capital or anything else. And so our job is to be good stewards for our clients of assets.
Got it. One more question on the Great Resignation. So you've seen during the COVID-19 pandemic, a lot of Wall Street firms, spend a lot of effort to keep their employees motivated and engaged, cultivating young talent that has, been difficult. Before the pandemic, already, private equity had emerged as a very attractive place, popular place to work on Wall Street, attracting a lot of, young investment banking client. Has this evolved, during the pandemic, and how has your approach to attracting and retaining talent evolved?
So we ended 2019 at roughly 1,200 people at Apollo. And as we sit today, we're 2,150. So it gives you a little bit. And in each of those years, turnover went down. We are, as I suggested at the outset, in a period of incredible momentum. We're a growth business. People are excited about what we're doing. But we, as an employer, have also learned a tremendous amount. We've learned that we don't need to see you in the office every day. And that's resulted in more flexibility for our workforce, whether it's 4-1 or 3-2. We also learned that we could work remotely very efficiently. And we opened new offices in Miami and in West Palm Beach. And each of our offices is undergoing its own upgrade. In addition, the workforce today is very concerned with what we do on, you say DE&I say opportunity, very big part of our culture, and what our mission is and what we're trying to accomplish, and just the informality and authenticity of what we do. So I've made it safe for everyone not to wear a suit to the office. I debated the suit for you today, but I figured we'd be just fine. This is what I look like every day. We are an authentic, informal, amazing place to work. And we really have not seen the so-called Great Resignation. We are entrepreneurs, but at scale. And for the right people, they just find that very attractive.
Got it. Marc, thank you so much. That's all the time we have today. Thank you to our audience, and I hope you join us again soon for the next Reuters Newsmaker interview.
Perfect. Thank you so much. Bye-bye.